Hey guys, welcome to the 5th episode of this series. Today we're going to be talking about what is a pip in Forex. When it comes down to making money in Forex trading, the profit or loss of each position taken is calculated by two factors, the pips and the lot size. If you are new to Forex, no doubt you'll be confused by all the strange and unfamiliar terminologies. Pips, for example, what the heck is it? However, for the sake of minimizing confusion and keeping this video very brief and small, we will be covering how positions are traded by focusing on the first factor of what is a pip in Forex. So, when it comes down to it, in Forex, earnings are expressed in pips. Now, pip is short for point in percentage. It basically represents the smallest amount of change between the current market price level versus the price level that has been initially positioned in. In currency exchanges, funds can be traded in even smaller denominations, down to 0.0001. This means that for very small movements in currency prices could potentially profit in very large amounts. But how do pips actually work? Let's take an example. Assuming we head over to the financial chart of US dollar and Japanese yen, with US dollar being the base currency and Japanese yen being quote, of course, and is currently trading at a market price level of 107.362, which means that for every $1 we would be getting 107.362 Japanese yen. So, in order to calculate profits, taking only pip for now into consideration, we're going to say, for example, a 1 pip increase in that currency price pair would be 107.363. So it went from 0.362 to 0.363. And if we plan to enter that trade at the 0.362, the trade profit or loss would increase by 1 pip, since it moved from 0.362 to 0.363. Now let's consider the same position taken at 0.362. If the trade closed at 0.350, the trader would lose 13 pips because the price decreased. But if, for example, the trader took a very good analysis and forecasting of the price level and it eventually increased, let's say to 0.412, it could potentially profit by 50 pips. It's those movements in the exchange rate that determine your potential profits. In simple, they're called pips. It's a factor of potentially making you money, but you have to understand what they present as in the meaning of it. So, when it comes to numbers, we should always be able to interpret them in order to understand what the numbers are trying to tell us. So in this case, when there is an increase against the base currency, which is US dollar, there would be an increase in its overall value. Meaning, if the currency pair was to increase to 0.363, the value of the US dollar would increase against the Japanese yen. Because for every $1, you would be able to buy more Japanese yen. But if it were to decrease, vice versa would happen. The value of US dollar would fall. Now, as we've stated before, to calculate profits, we'd have to focus on two factors. We'd need the pips and the lot size. Pips mean nothing without the effect it could have on your position. In simple, would it affect your position by $1 if it increased by 1 pip? Would it affect it by $5? Would it affect it by 10 or 1,000? That's where lot sizes come in, and we're going to be discussing it in the next video. Hope you guys enjoyed it. I'll see you guys in the next one.